AI bots, huh? Do you have a thought like, what do AI bots know about stock trading? Stock market requires insights, timing, and a level of genius that only humans can have. It's the right time to change your thoughts. Yes, we welcome you to the world of algorithmic trading. 84% of trades that happen in the NYSE, 60% in the LSE, and 40% in the NSE were done using algorithmic trading. From the looks of it, it seems sooner or later every trade will be done using algorithms. What is algorithmic trading systems? Algorithmic trading systems use mathematical models to analyze financial markets and tells you when to buy, sell a stock, and when to book profits or cut losses. Benefits of algorithmic trading. Human emotions equal 0. Accuracy plus speed equals 100. Comfort equals 1000%. Scalability equals 100. Interested in setting up your own algorithmic trading desk? Get help from Emma2TradeLiveSignals.com. We are now offering 2-week trial now. Join now and get trained by our experienced traders in a real-time trading room. This introductory package includes 27 daily signals from 8 different markets, unlimited access to the live trading room, and unlimited consultations with Patrick. Get the exact entry points, targets, exit points every single day. Real-time texting and email signals. Daily, weekly buy and sell reports before each trading day. Monthly reports and objectives before each month. Get started to trade your own money with confidence and without frustration. Visit www.ema2TradeLiveSignals.com.
Welcome to the Marketplace Roundtable podcast. We speak with Seeking Alpha Marketplace authors about their investing styles, their views on the market, and their favorite investing ideas. I'm your host, Jonathan Liss. Before we begin, a brief disclaimer. Seeking Alpha is a website where authors from around the world share their ideas and analysis on the stock market. The Marketplace is our platform for authors to run investing analysis and idea services so that readers can take their investing to the next level. Nothing on this podcast should be taken as investment advice. A full set of disclosures will be provided at the end of this podcast. For reference purposes, this podcast is being recorded on Thursday, February 21st, 2019. I'm joined today by the Equity Management Academy's founder and CEO, Patrick MontesDeOca. After 30 years working as a trader in New York and Chicago, Patrick started the Equity Management Academy out of a deeply held belief in the power of education to change lives. The Academy's objective is to help all levels of traders, from beginners all the way through veteran experienced traders, become more effective at transforming knowledge into wealth. The centerpiece of the Academy is embodied in the fully automated proprietary trading program, the Variable Changing Price Momentum Indicator, or VCPMI for short. The Academy also assists institutional traders and hedgers. Patrick and his team at the Equity Management Academy joined Seeking Alpha as contributors in 2017. Seeking Alpha reports are based on the VCPMI analysis of various markets, including S&P 500 minis, gold, silver, and Bitcoin, and written by Scot Macdonald, PhD, who is the Director of Research for the Equity Management Academy. This past December, Patrick launched the Mean Reversion Trading Marketplace service here at Seeking Alpha, offering key trading reports from the Equity Management Academy to Seeking Alpha's subscriber base. These include weekly reports for the gold, silver, and E-mini S&P 500 markets using the VCPMI, precise entry, exit, and stop points for day swing or long-term trades, and special report when a market warrants immediate attention. You can subscribe to Mean Reversion Trading either by going to seekingalpha.com/marketplace and looking for Mean Reversion Trading, or by typing Mean Reversion Trading or Equity Management Academy into the search bar at the top of the site. All right, let's get into it. Patrick, welcome to the podcast.
Thank you so much for that wonderful introduction, Jonathan. It's a pleasure to be here.
Yeah, great to have you. So if you could tell our listeners a bit about yourself, what is your relevant background? When did you first become interested in investing? How long have you been doing this for, and in what capacity?
I think the first time that I fell in love actually with trading was the first day I walked into the COMEX trading floor. I was just so overwhelmed by the activity, the noise, just the smell of it, the whole thing was so exciting. And somehow I, had a premonition in a sense, not understanding what those boards meant, the prices changing constantly. I said, wow, one day if you could automate this, it would be really, really incredible. And so that was my introduction. That was more than 30 years ago. I became a consultant for the Mexican government at the time, technical analyst. I was a technical analyst also for some major coffee producers in Colombia, Latin America. And so that was pretty much my introduction into trading floor. And as a result, obviously, I became very much connected with technical analysis. I identified with technical analysis and began to develop my personality, more as a technical analyst and a fundamentalist, understanding that a lot of the fundamentals that I became in contact with were actually, kind of behind the market or lagging the market. As I found out as well, that most technical indicators are lagging indicators. And so by testing, my own trading, by understanding the dynamics of the market, learning about supply and demand levels, and finally understanding the reversion to the mean in price occurs, in the marketplace as a natural process of prices adjusting to an equilibrium where you find a balance, so to speak, of supply and demand. It took me a little while to understand that. So, but the initial contact was trading the pivot points on the floor brokers. I began to share some of the work that I did, with people on the floor or the clients that I was able to have, and slowly but surely, began to write more based on demand, and until I think it was about 2003 sometime, I was asked by Consensus magazine to publish, and that's when I began to publish, basically. So it kind of evolved from a general technical letter into what is now a completely automated indicator.
Sure. And how did you develop your trading system, the VC PMI system? What is it, first of all? How does it work? What kind of inputs does it take? And then how is it developed exactly?
The basis of the artificial intelligence uses Fibonacci sequences. It uses Gann formulas, and it uses supply and demand levels. And what it does is it basically defines a very specific structure. For example, most people look at supply and demand levels every day, resistance, support. Some people look at pivot points. More or less, they're all related to the extreme levels of the market, above and below, you might say, the resistance or support levels that some people call. One of the things that, for myself, I was curious to find out was why was it that when I was a trend trader and I would follow a trend, and usually, let's say, into a weekly peak or a monthly peak, and you would get the confirmation, and I'm an options trader, and I when I trade, I usually do size in options because of the limited risk, but you have to be precise in timing, otherwise the premium just collapses, and you wind up taking a bath. And so I would follow classical technical analysis. I would follow the rules and philosophy, and I would buy into a breakout. But then the market would collapse after that, almost every time that I would do that. And I began to question what was the factor behind that which would make the price do that after completing, let's say, a target, or after completing a confirmation of a monthly breakout or a weekly breakout. And then I began to understand the reversion to the mean principle, in that within the market structure, you have the levels of supply and demand, where the price is dictated based on the amount of demand that enters into the market that is able to absorb the supply or the selling that is against it. And that's what determines the direction of the price, basically, based on my observation. And so what the artificial intelligence does is it identifies a very specific structure of 5 levels, which are pivot points. But, the question is, why 5? Well, we use the Fibonacci sequence of 5, which is a perfect number, a perfect structure. We wanted to create a perfect structure using the Fibonacci premium number of 5, basically.
Right, and I guess you have 5 waves and Elliott wave. I mean, I guess a lot of Fibonacci-based systems.
Exactly. So, exactly. That was our handle in identifying the consistency, or identifying. What really happened is that I began to realize that price is not the leading indicator of the market. The energy behind the price is the leading indicator. And the price is the consequence of that energy. And so I said, interesting. If I could develop a program that would be able to identify the energy prospectively, boy, that would be really interesting, And so I began over the years to put together a combination of different programs. I began to, beta test different indicators, and finally developed the structure that we're using now, which is of 5 levels, 5 pivot points. But the artificial intelligence goes further into identifying the color. It gives you a color within those levels. And for example, it gives you 2 levels of red, 1 level of green, and 2 levels of blue below the green. And the red levels basically give you the visual of demand, and it tells you if the price reaches these levels in red, it's in demand, it's in supply area. Okay, so right away it gives you a kind of visual idea where the market is. If it comes down into the blue levels that we call B1 and B2 levels, because it identifies further, once it identifies the color, it identifies the extreme level of the relative implied volatility, 1-on-1 factor and 2-to-1 factor below the mean. It identifies the average price of the mean very specifically, okay, and then it gives you two levels above the mean, which give you a 90-95% probability factor that the reversion will occur back to the mean if certain criteria is met. Same thing below the market. And so what we have done is created a structure that identifies the extreme levels of the implied volatility above or below the mean. And it gives you now a level which says sell 1 level. This is GAN formula is now being incorporated, that it identifies every day, once we get the average price, where the extreme above that mean or where that sell 1 level is going to be. To use an example, the mini, information for today, let's say for day trading today, the average price coming into today is 27.84. Okay, the extreme above the mean for today, and the beautiful thing about this system is that coming into the as I call the floor to trade, you're going to know exactly what you're going to do. It's not at random that you're going to trade, or you're going to try to figure it out during the day what the market tells you. No, you already have a structure, you already have a plan to execute when you come in to trade. And that gives you that puts you 50% ahead of everybody else. And all you need to do now is let the market trade between these pivot points. The artificial intelligence will tell you. When you come into the room, if you're a day trader, you have no position, correct? Because you have to liquidate every day at the end of the day if you're day trading. Right or wrong, profit or loss. So let's talk about day trading. You come into the room, you don't have a position, you see the price opening, the average, let's say, is 27.84, and the price is trading below the average at, let's say, 27.77, okay? Right there, it's telling you that the price is below the average, therefore it is a bearish trend momentum. When the price is below the average, it's bearish. When it identifies that trend momentum, which is what I call from the VC PMI or the equilibrium or the mean, okay, when it's trading below, it identifies a bearish trend momentum. But the artificial intelligence goes further. It doesn't just tell you it's a bearish trend momentum. It identifies a target, and it tells you buy one level at 27.76 with 90% probability that the reversion might occur from that price back up to the mean. The B2 level is 27.66. This gives you a 95% probability that the reversion will occur. The price action today came right down into a low of 27.74. It came right into the level of demand between the B1 of 27.76 and the B2 of 27.66, which is in blue. And you get access to this information when you come to the website. You're with me. I give you this information. It's posted the day before the market opens. By about 9 o'clock, I think, Pacific time, we post all the information. The automation on TradeStation posts this information by 4 o'clock. So you can have this information ready for you to trade the Globex. You with me? If you're an active trader. And furthermore, you know, for active traders, we have an elite chat room that we invite, professional traders only, which pretty much updates the room or the chat room 23 hours a day when any signal is produced. And so here, coming back to today's action, you know, the market came down, made a low of 27.69, I think was the low here today, all right? And I tell you, you wait. When it comes back up above and closes above 27.76, the B1 level, it activates a buy trigger.
And does your system actually execute the trade there, or is the investor doesn't have to manually put in the trade?
Well, there's two types of investors that we have to define. There is a self-directed trader that likes to execute his own, and there is an automated trader that likes to have the automation execute the signals. And there is a trader that is using both now to optimize his self-directing trading, which is what we're doing in the room. Because the automation we're finding, even though it is automated and it's like a little ever-ready rabbit that buys and sells, and it is a one-dimensional algorithm. It only buys one and sells one. You with me? It doesn't tell you how to money manage. It doesn't tell you how many size to do. It doesn't tell you where the harmonic alignment is in all the trends. So I do the work individually to identify, using daily criteria, the daily data that is provided that gives you very specific prices to day trade. We provide a swing or a weekly data, which is what we publish in Marketplace, that gives you the weekly data for you to trade, swing trade or position trade. And the accuracy is the same. When, you know, we're talking about probabilities. And if you look at the gold, for example, if you look at the report that we published last week, it told you exactly to get out if we get in gold above that 1348 or 1350. The monthly mini S&P report that we published on February 1st told you to get out near 2798 on the mini. So this is prospective information that you have, that when the market reaches these levels, it would activate a methodology for you to execute. And then we teach you how to combine the daily information with the weekly and the monthly, as you know, most trend traders do. Look at, you know, the daily trend, the weekly trend, and the monthly trend. The difference is that the algorithm and the artificial intelligence tells you, prepare, be alert, a short signal has been activated on all the trends, which is what happened in the gold market and silver yesterday, and it's happening in the mini S&P as of today.
Sure. And we're talking about traders a lot here. I was just wondering, somebody who spent 30 years, a lifetime really, as a professional trader yourself, what kind of insights you had into, psychologically speaking, what does it take to be a good trader? is this something that really anybody can do, or are there certain types of people or people with certain types of characteristics that maybe are not well suited for this, and that only certain types of people should be trading like this?
That's a good question, because that's a big question, when you are trying to identify personalities. The one thing I can tell you is that anybody can learn to trade if they really are passionate, they want to do it, and they're willing to put the discipline and the commitment to do it. What I would say, the first thing is learn to manage your emotions. And along with that is your greed factor. A lot of people come into this business with a misconception that, you can come in and take a position and become a multimillionaire overnight. And it does happen, but it's like winning the lottery. The reality of what I have seen over the years is that this business is all about managing risk. And if you can become a specialist in managing your risk, not caring about where the market is going, or listen to CNBC and get emotional and buy into the rumor, and so on and so forth, which 90% of the people do. As you've heard, that 90% of people lose money trading commodities.
Mm-hmm.
But
similar in the equity investing
Correct.
space also, that the typical fund return is actually higher than the typical return experienced by most investors, because people end up getting in and out at the wrong time.
Exactly.
Because they misuse their emotions.
Because the market will do that. The market will make you emotional, and the 10% makes a bloody fortune on that 90%. That's what people don't talk about. Okay?
Sure.
And so when I realized that equation, I said, oh, let me see why. And of course, I began to understand the reversion to the mean and what was happening to me when I mentioned earlier that I would buy on a monthly breakout, to the upside. The reversion to the mean will occur, and you'll get a 50% retracement, Fibonacci, or even sometimes 78 before the market resumes again, the next wave up or the next pattern. And once I understood that market function is to use the speculation of the market to bring prices to an extreme, which it does. And from my observation, it's about, I would say, maybe 30% speculation in the market at least, that drives the prices to extreme levels above or below its equilibrium price, where it should be based on its economics. And so one thing I can say is that if you're coming into this business, you want to give yourself a chance to understand the economics and the functions of the market first. How does the supply and demand functions in trading the market? Because that's what you're doing, whether you're speculating, whether you're buying in the future or a stock, or you're speculating. And depending on the market direction, trend direction, you with me, that sometimes brings a cluster of investors, you might say, at a specific price and drives the price to extremes. This indicator is contrarian to that sentiment. When 90% of the sentiment is out there buying, like right now, like yesterday in the metals, for example. And I just published a report today, in fact, in the gold market, and I said gold is a bull trap. That was yesterday, when market was making new highs, and I think we completed the sell 2 target in gold, and tells you, liquidate, go neutral again, and wait for the price to release the speculation energy out of the market and come back to test the mean. Once it tests the mean, it will trade around there for a little while. You see, the mean is a standard deviation 50-50. And so understanding that as a trader, what I'm teaching and what I want to do as a trader is that if you're a trader, you want to trade the highest probability in your favor. And the VCPMI is able to tell you the average price today is 27.84. If the price closes above 27.76, which it did, it activates a buy signal. automatically, and that signal came in at 27.77.75 at 8:45 a.m. The minute that it activates that trigger, that buy signal, you go long, it tells you put your stop below the market, below that pivot. Automatically, it locks in the structure of the stop, and the target above is activated, and it locks in that structure. So either the market is going to give you the opportunity to lock in, as it did, from there went up to 27.81.75, and it's going to give you an opportunity to manage your profits, either with a trailing stop, or, you with me? It gives you the opportunity to make profits, but you have to be active in managing it, because the robot or the market is not going to do it for you. More than likely, it'll take it back. So you have to be active in the management of your profits.
Yeah.
As well as your losses here, but fortunately what this does is it identifies, I think, on a probability level where those areas would be of greatest percentages. And that's, as a trader, what I want to do. It's very clear for me, when I need to trade, and that's when the market tells me to do it. Basically put my emotion away at that point. Oh, it's easier said than done. Believe me, I'm a trader, and as long as I think I'll be alive, it's one of those things where you, as I said, more and more, what this whole thing is about, as I'm finding it, is managing. How do you manage your risk? Once you identify the signal, for example, and once the code, it's like a GPS for trading. If you're a day trader, it comes in, it gives you a structure, it gives you 5 levels. The price will activate those levels. If it's on B1, it activates it at trigger point. You go in, you buy. You with me? And it tells you pretty much what to do. But it doesn't tell you do 5 or 10 or 20 based on your size, you see. And so that is something that as long as I've been around, I have found that is something that you can tell, or you can generalize and say, coming back to your question, to every trader, that they should be able to do this, because they got to find out first their size. They got to find out first who they are. They got to find out first what it is that they're looking to do. They got to find out how much risk are they willing to take. They got to be very specific and clear and have a plan. If you don't, you're at the mercy of the market, and I wish you good luck.